This is Steve, an average human being. Steve has worked hard for the last 4 years, and what he's done is he's saved up some amount of money and he's ready to buy his first property. So Steve has saved up around $100,000 and what he's doing is planning to buy a $500,000 property. He doesn't quite have enough money to buy off that $500,000 of property. He has only $100,000, which is 20% of that property value. Steve is hoping to get that money from somewhere, and he's trying to approach the bank to get that money. So he goes to the bank, he says, "Hey, Mr. Banker, can you please give me $400,000? So he approaches the bank, he says, pretty please, can you give me that $400,000? The bank says, "You know what, Steve, most certainly we can. But you know what, we got two conditions for you, Steve. The first condition is you got to pay us that $400,000 back in monthly installments within X years. Let's say 30 years, Steve, because we don't want to put pressure on you. And the second thing as well, Steve, is what we're going to do is we're going to charge you a percentage of interest every year on the remainder of the loan amount which you have to pay us back." So basically the first condition would be your principal of your loan, and the second condition which you're going to pay off interest is going to be your interest of your loan, which you can pay both of these back to us on a monthly basis. So essentially your home loan would be a principal plus interest. So Steve says, "Awesome, Mr. Banker, that's great news. So can you please give me that money so I can go and buy this property?" The banker says, "You know what, Steve, most certainly we can, but however, before you do that, please decide on what type of loan you want to get." Steve's like, "Wait, what do you mean by different types of loans?" "Well, Steve, good question. We've got 5 different types of loans. These are the different types of loans. We've got home variable rate loan, we've got fixed rate loan, we've got interest only loan, we've got guarantor loan, and we've got low docs home." Steve's like, "What? Wait a minute. What do you mean? I'm confused. Can you please explain this to me, Mr. Banker?" Mr. Banker says, "You know what, Steve, I'm more than happy to explain it to you. Let's start off with the first one, which is variable rate loan. So a variable rate loan, think of it like this. You've got the big bank over there, which is called Reserve Bank of Australia, or also known as RBA. You know what? This big bank decides the interest rate. And how do they decide this interest rate? Is based on the cash rate." Steve's like, "What do you mean by cash rate?" "Well, think of it like this, Steve. If the economy is doing really well, you know what, people have a lot of jobs, so there's good cash flow, people can afford having a good lifestyle. So based on that, what we're going to do is we're going to charge you a higher interest rate because the economy is doing so well. But let's say now the economy is not doing so well. Let's say not a lot of people have jobs. Let's say there's not much income and not a lot of spending happening in the economy. So the economy is not on a good terms right now. It's on a bad terms and it's doing really bad. So because of that, people can't afford to pay a lot of money. So let's make the interest rate lower." So that is basically what the cash rate is about. And the RBA is what decides the cash rate. And then based on the RBA, we set our interest rate around that. So Steve's like, "Okay, well, can you explain it a bit more?" "Yeah, sure. So let's think about it like this. RBA set the cash rate to 0.25%. So based on that, what we're going to do is we're going to give you, Steve, a 2.5% interest loan. But now let's say the RBA set the cash rate to 2% because the economy is doing so well. So what we're going to do, Steve, is we're going to charge you actually a 5% interest instead of a 2.5% interest. Steve's like, "Wait a minute, but why do I have to pay more or lower because of what the cash rate is?" Well, it says, "Well, Steve, that's what a variable rate loan is, and we charge based on the RBA, what they said." So essentially, Steve ends up paying 2.5% and pays a principal on a monthly basis. The cash rate does go up. Steve does pay more interest rate, and interest rate can change at any given point in time. Steve says, "You know what are the benefits of me really getting this loan then?" Well, he says, "Good question. You get these 3 really benefits from getting a variable rate loan. You get extra repayments, you get redraw facility, and you get an offset account." Steve's like, "Wait a second. What do you mean? Can you explain these 3 points to me a bit more in detail?" Mr. Banker says, "No problem. So let's start off with what are extra repayments." Well, think of it like this, Steve. You're paying off your principal every month. And now what you can do, Steve, is you can pay off your loan quicker if you like. So instead of paying your, let's say, $2,000, which you pay every month, you can pay us $4,000, which is an additional $2,000. And then this will reduce the duration of your loan because you're paying down your loan a lot quicker. And also this helps you reduce your interest rate over the long period of time because you're paying off your loan a lot quicker, so you end up paying a lot less interest over the course of your loan. Steve's like, "Oh, that's awesome. That sounds really good." And you know what? Let's get to the next point as well, which is a redraw facility. So what the redraw facility is, because you're making extra repayments, you can redraw from that section and take out money if you need to. So this way you get the privilege of redrawing that extra money you put into the account. And says, so that makes sense. So that is what a redraw facility is. It says, yep. And then what's the third point, Mr. Banker, which you said about what is an offset account? Well, good question. An offset account is a separate transaction account, Steve, which is linked to your home loan account. So this is basically a transaction account where you can add money, remove money, and use it for everyday expenses. And what happens is how much ever money you put in that, it offsets your interest. Steve's like, oh, what do you mean? Can you give me an example? Says, yeah, sure. Think of it like this, Steve. You've got $400,000 and you've got an interest rate of 2.5%. So interest you're paying every year is $10,000 right now. And that is without an offset account. Now, let's say you have a transaction account. And in that transaction account, you've accumulated or you have $50,000 cash. So what that's doing is that offsetting about $400,000 of your loan. So essentially the loan amount is no longer $400,000, but it is $350,000. So the new interest you pay yearly would be $8,750. That is with your offset account. Steve says, that makes sense. That's awesome, Mr. Banker. Thank you for that information. It says, what about all the other types of loan, Mr. Banker, which you told me about? So Steve, that's great. Let's start off with the fixed rate loan. So fixed rate loan, think of it like this, Steve. You take a loan from us, and you know what? We're not going to charge you a variable rate loan. We're going to charge you a fixed loan, fixed rate interest. So what that means is we're going to lock you in with a rate for 1 to 5 years, usually on a longer period of time. And you don't have to worry about what the cash rate is, whether the economy is doing well, whether the economy is downwards. You just pay us a fixed amount of money every month, which is your interest fixed and your principal is also fixed. So Steve says, okay, what are the benefits of getting this type of loan? Well, that's a good question. You've got basically a fixed rate you pay. The interest doesn't change. And the benefit of this is you don't have to worry about paying higher interest rate if it does go up. So you ideally want to use this type of loan when the interests are already really down. So for example, right now the economy is down, so you can use this to get a fixed rate home loan and you don't need to worry about variable going higher or the interest going higher. You're just paying that for the next 5 years. So you want to use a loan to get a good deal out of it. So that's what the point of the fixed rate loan is. Steve says, that makes sense. So essentially with fixed rate home loan also, because it's fixed for that duration period of time, you're not allowed to make any more redraws or extra repayments or even have an offset account around that because we're just making it fixed so you don't have to worry about anything anymore. Steve says, what about the third loan which you told me about, Mr. Banker, interest-only loan? Well, that's a good question, Steve. Let me explain that one to you. So the interest-only loan is basically a type of loan where you do not pay principal for the duration of the interest-only loan. And instead what you do is you only pay us interest for that period of time. Let's say it's for a 5-year loan, which you've got an interest-only loan. So what you do is you avoid paying principal and you only pay us for that 5 years interest only. Steve says, okay, that's interesting. And because you're only paying us interest, Steve, what we're going to do is we're going to charge you a higher interest rate than other type of loans out there because you're not paying us principal. So we're liable for anything that happens to your property. And so that's why we're going to charge you a higher interest rate. Steve says, what are the benefits of me getting this loan, Mr. Banker? Well, it's actually a good question. This loan is great for when you want to get an investment property, Steve. But think of it like this. You've got a rental property, Steve, you bought one, and now you're getting a rental income. You're going to pay a portion of that rental income back to us as for the loan which you're getting on the interest. And what are you going to do? The remainder of the money you're going to keep with yourself. And because it's a 5 period also, what's going to happen is the property market can change at any given moment of time. It can go higher. It can also go lower, Steve, your property value. But let's say it goes higher. Then you hold on for 5 years. And then what you do is you can sell that property, or you can come back to us and you can get it refinanced as well, your loan. So those are the privileges of getting interest-only loan when you're planning to make an investment. Steve asks, okay, Mr. Banker, what is guarantor loan? Well, the bank says, you know what, Steve, that's a good question. Let's say you have, instead of your $100,000 which you have, which is 20% of your deposit for that property, let's say you have lesser money. Let's say you have 10% instead of that. So what we're going to do is, because you don't have enough money to put in as a deposit, you can make someone a guarantor for your loan. So essentially you want to borrow more than 80% of the property, And you can put a family or a friend or your parents or anyone as a guarantor for that portion of that remainder deposit as a home security. So this way you have someone who's guaranteeing you for the remainder of money, and if let's say you do not be paying the loan, we will use their property as security against that whole loan. Mr. Steve says, you know what? Okay, that makes sense to me. So what about if I'm self-employed and don't have enough documents to show my earnings? What about that, Mr. Banker? Then can you arrange something for me? Well, Mr. Banker says, you know what? That's actually what we call a low docs home, Steve. So what you do is you provide us your income declarations and other financial statements, and what we do is we review these things. And because you have bare minimum documents and you don't have enough things to show to us, what we're going to do is we're going to give you a loan, but we're going to give it to you on a higher interest rate. And that's what essentially a low docs home is, Steve. So Steve says, thank you very much, Mr. Banker, for explaining me all these different types of loan. So what I've decided is I've decided to go with a variable rate loan because simply I feel more comfortable that I will pay off the loan a lot quicker. So, and I want that flexibility of the offset account. So you know what, I'm going to go with a variable rate loan. And right now also the cash rate is really low. So it may just make sense, Mr. Banker. And then what he does is he goes and gets a variable rate loan. And so Steve gets that loan, and he arranges all that money, $400,000 from the bank and $100,000 from himself. And then what he does is he pays it to the property. And now he's a new property owner. He's finally successfully got his first property. And that's what really home loans are all about. If you guys did enjoy this video about home loans, then please do give this a like and please subscribe to my channel. I would really appreciate it if you show me your support, and also Steve would also love it if you do subscribe to the channel. So please do subscribe, where I'll be posting a lot more videos like this and about investment in stock market. So yeah, until the next video, take care. Bye bye.